Listen to me very carefully. Look at your most recent bank statements right now. Because if you are 65 or even just approaching 65 and you make one specific type of deposit, the IRS is going to quietly lock your account into a brutal compliance trap. And they're going to slap you with a heavy 6% excise tax. But here is the absolute worst part. They won't just tax you once, not even close. They are going to drain that same exact money year after year forever. And less time, welcome back to the channel. Today we are breaking down a catastrophic financial death spiral that your financial advisor is completely ignoring. And trust me, the government definitely isn't warning you until the penalty notice shows up. We're talking about the massive, ugly collision between Medicare, your health savings account, and the absolute disaster it triggers with your Social Security checks. Why do you need to stick around until the very end of this video? Because I'm going to hand you the exact legal codes and the exact IRS forms you need to disarm this ticking time bomb. But before we get into the tactical stuff, let me be totally real with you. This is high-level financial education, not personalized legal or tax advice. So please chat with your CPA before making any wild moves. Make sense? Because I need you paying close attention. This isn't just about a tiny 6% tax. That 6% penalty, that is literally just the first domino falling. If you try to fix this the wrong way, like most people do, you will trigger a massive chain reaction that artificially inflates your taxable income overnight. It's going to cause the government to aggressively hike up your Medicare premiums and violently slash your monthly Social Security checks. It's the ultimate matrix glitch. So how do smart, responsible people fall straight into this ridiculous death spiral? To understand just how sneaky and insidious this trap is, we need to talk about a guy named Richard. Richard is 66 years old. He's a sharp guy, an engineer, and he's basically crushed his finances his whole life. Like millions of Americans right now, Richard decided he didn't want to retire at exactly 65. He loved his job, so he kept on working full time. And because he kept working, he made what seemed like the smartest move ever. He stayed on his employer's high-deductible health plan. And since he was on that plan, he kept aggressively maxing out his health savings account. I mean, why wouldn't he? The HSA is literally the holy grail of tax loopholes. You get tax-deductible contributions, tax-free growth like a weed in the stock market, and tax-free withdrawals for medical bills. It's like the ultimate cheat code. But then Richard made one fatal, incredibly innocent mistake that basically ruined everything. When he blew out the candles on his 65th birthday, he didn't claim Social Security right away, but he did enroll in Medicare Part A. Wait, why on earth would he do that if he was still working full-time? Because the HR department at his company, and literally every single generic advice forum on the internet told him it was an absolute no-brainer. And they said, hey man, Medicare Part A is totally free. You've paid into it forever. You might as well sign up for it. It literally costs you $0 out of pocket. Sounds perfectly logical, right? So Richard clicks enroll on Part A. He felt great about having a little extra safety net just in case, right? And he kept diligently depositing $4,000 a year straight out of his paycheck into his beloved HSA, thinking he was being hyper responsible. But here's the crazy part that nobody in HR bothered to tell him. In reality, Richard hadn't just signed up for free health care. He had just lit a massive stick of dynamite under his entire retirement plan. You see, there is a brutal, unforgiving rule buried deep inside the American tax code. And this is where things get really dark. Because the system isn't designed to tap you on the shoulder and say, hey buddy, you messed up. The system is designed to sit back, watch you make the mistake, and start charging. Richard thought he was playing by the rules. He thought doing what everyone else does, grabbing that free government benefit, was the ultimate smart money move. But in the eyes of the IRS, Richard just went from a law-abiding citizen to a massive liability. I'm going to show you exactly what happens behind the closed doors of the IRS the exact second Richard's Medicare Part A went active. Because the moment that happened, an invisible tripwire was crossed, and the countdown automatically started. We're about to dive into the actual Internal Revenue Code, and I promise you, it is going to blow your mind how perfectly engineered this trap is. But wait, does his CPA even know? Will his bank warn him? Let's find out. Here is the brutal, unforgiving reality of the American tax code. Under Internal Revenue Code Section 4973, if you want to contribute a single dime to an HSA, you must be enrolled in a high-deductible health plan. And here is the absolute critical part you cannot afford to mess up. You cannot be enrolled in any part of Medicare, not Part A, not Part B, absolutely nothing. Zero exceptions. The very second Richard's free Medicare Part A became fully active in the system, his legal HSA can shock and your contribution limit immediately slammed all the way down to zero. Every single dollar he put in after that date was basically illegal. But hold your horses because it gets exponentially worse than a simple zero limit. Medicare has a secret trap door built right into its core code. It's a bureaucratic nightmare they officially call the 6-month Retroactive Rule. When you hit enroll in Medicare Part A after your 65th birthday, the government doesn't just start your coverage on that specific Tuesday. They automatically backdate your coverage by up to 6 full months. And guess what? You don't get a single choice or say in this matter. It is completely hard-coded into the bureaucratic matrix. So if Richard applies at age 66, Medicare legally considers him to have been enrolled 6 months prior to his actual application date. Do you realize the absolute sheer horror of what that actually means for his bank account? It means every single dollar he or his totally oblivious employer deposited into his HSA during those previous 6 months. And everything deposited after is instantly classified by the IRS as an illegal excess contribution. And let me be real with you, when you make an excess contribution, the IRS doesn't send a sweet little warning letter. They hit you right in the teeth with a 6% excise tax. And here is the absolute kicker that ruins people's financial lives. This is not just a one and done parking ticket. The IRS actively uses a specific document called Form 5329 to track this exact mistake. If Richard leaves that money sitting in his HSA, the IRS will happily tax that specific deposit at 6% this entire year. And if he doesn't figure it out and rip that money out, they will tax it at 6% again next year and the year after that. It is a recurring, relentless punishment. Your answer, Rookie. It's compounding interest but working purely evil against you instead of for you. He is literally getting financially bled out for a mistake he didn't even know he made. It's like a gym subscription from hell that you can never, ever unsubscribe from. But believe it or not, this is exactly where the real nightmare officially begins. Because eventually, the truth always comes out in the wash. Fast forward to tax season, and Richard's CPA finally spots the catastrophic error staring right at them on the spreadsheet. And when his CPA drops the bomb and tells him he needs to fix it instantly, Richard is going to completely panic. I mean, wouldn't you? You've got the IRS breathing down your neck with a compounding penalty. Your gut instinct is to act fast and clean it up. And in his desperate, blinding panic, Richard is going to accidentally pull the lever on the tax guillotine. He's going to try to DIY his way out of a hyper-complex tax hole. He thinks, oh, I'll just pull the money out, apologize to the IRS, and we are all good to go. But the IRS doesn't care about your apologies, and they certainly don't play nice with rookies. If you don't use the exact, incredibly specific method to pull that money out, you are essentially pouring gallons of gasoline on a raging grease fire. And Richard is holding the match. You won't believe the catastrophic chain reaction this one panicked decision is about to set off. We are talking about waking up a sleeping giant, a mechanism literally designed to gut your retirement income and leave you scrambling for pennies. Are you ready to see how one wrong phone call to a bank destroys an entire retirement plan? Richard is staring at the ceiling at 3 a.m., sweating over this 6% penalty. He wants this problem gone yesterday, so he picks up the phone and makes the most dangerous call of his life. He dials his HSA custodian and demands they send his money back immediately. He tells the bank, "Hey, I made a mistake. Cut me a check for the excess cash." And the bank, doing exactly what they are told, sends him a check for the excess contributions, plus all the juicy earnings those contributions generated in the stock market. Now, Richard thinks he is totally in the clear. The money is out. The mistake is fixed. He can finally sleep. But what Richard completely fails to realize is the sheer toxicity of those earnings. Because those earnings on that excess contribution are now fully taxable as ordinary income. Suddenly, out of absolutely nowhere, Richard has a massive, completely unexpected spike in his taxable income for that specific tax year. He just artificially inflated his own wealth on paper, and you'd better believe the government is watching every single penny of that income spike. He just essentially painted a giant target on his own back for Medicare to come hunting. The dominoes are perfectly lined up, and Richard just flicked the first one over. We are about to enter what I call the IRMAA death spiral. Now, let's look at the second massive domino in this twisted game. It doesn't fall right away, which is what makes it so incredibly deceptive. Fast forward exactly 2 years later, Richard finally officially retires for real. He proudly claims his Social Security, buys some golf clubs, and gets ready to kick back and enjoy his golden years. He thinks he has successfully crossed the finish line. The IRS is off his back and life is good. But when he walks to the mailbox and opens his very first Medicare premium bill, his jaw literally hits the floor because his premiums for Medicare Part B and Part D haven't just crept up by a few measly bucks. They have absolutely exploded. We are talking astronomical budget-breaking numbers that make zero sense. Why on earth did this happen? It's all because of a vicious little-known government acronym called IRMAA, the Income-Related Monthly Adjustment Amount. It sounds super boring, but it's basically a financial apex predator. You see, Medicare premiums aren't just some flat rate that everyone pays equally. They are directly tied to your MAGI, your modified adjusted gross income. But here is where the government completely pulls the rug out from under you. The government doesn't care what you're actually making today while you're sitting on the beach retired. They use a rigid 2-year look-back period. They look at your tax returns from exactly 2 years ago. And guess what happened exactly 2 years ago in Richard's world? That was the exact year Richard panicked and withdrew his excess HSA funds the totally wrong way. That sloppy panicked withdrawal and the taxable stock market earnings attached to it artificially spiked his income on paper. And that temporary fake spike was just enough to push his MAGI over the invisible IRMAA threshold. Now, the government automatically flags his file and officially labels him a quote-unquote high-income earner living large, even though in actual reality, he is just a normal, everyday retiree trying to survive on a fixed income. And let me tell you, the government doesn't ask you politely to pay this IRMAA surcharge. They don't send you a nice friendly invoice hoping you'll mail them a check whenever you get around to it. No, they forcibly deduct that massive surcharge straight out of your Social Security check before you even see a single dime of it. It's essentially a legal mugging in broad daylight. So right out of the gate, Richard's monthly Social Security check is drastically smaller than he ever planned for. He's suddenly short on the cold, hard cash he actually needs to pay his monthly bills, buy groceries, and keep the lights on. What does a desperate, cornered retiree do when they are suffocating for cash? They do the only thing they can do to survive. They pull money from their pre-tax 401k or traditional IRA. Do you see the massive trap completely closing in on him now? To survive the brutal monthly shortfall entirely caused by that IRMAA surcharge, Richard is forced to pull a large lump sum out of his traditional IRA. But wait, guess what happens the moment you pull money out of a traditional IRA? That IRA withdrawal is 100% fully taxable as ordinary income. Because it's taxable, it aggressively drives his gross income right back up again for this current year. which means like clockwork, exactly 2 years from now, the government is going to audit his MAGI all over again. And he is going to get violently hit with the exact same IRMAA surcharge all over again. His Social Security will be slashed again, and he will have to drain his IRA yet again. He is officially caught in the relentless, terrifying grip of the IRMAA death spiral. It is a perpetual motion machine of wealth destruction, a literal black hole for his retirement savings that just keeps sucking him back in. And the absolute craziest part about this entire horror story, it all started simply because he made a totally routine, responsible deposit into a health account at age 65. Because he clicked a button that said free government health care, he is now bleeding out his life savings. If you are watching this right now and your palms are sweating, I totally get it. If your heart is beating a little faster because you are in this situation or getting dangerously close to it, take a deep breath right now. We aren't going to leave you stranded in the matrix. I am going to give you the exact step-by-step sequence to totally disarm this trap. But let me be crystal clear right up front. Sequence is literally everything when dealing with the IRS. If you try to shortcut this and do these steps out of order, you will instantly trigger the penalties we just talked about. You have to move like a precision surgeon. Are you ready to see the exact 4-step escape plan that rich people use to bypass this mess entirely? Here is your exact 4-step escape sequence. Grab a pen because you cannot afford to mess this up. Sequence is everything. Let's jump straight into step 1, what I like to call the 6-month buffer strategy. If you are planning to delay Medicare and Social Security past age 65, and you're still stuffing money into that HSA, you have to hit the brakes hard. You must forcefully stop all contributions, including your employer's matching contributions, exactly 6 months before applying. Why? Because you have to build an invisible shield against that automatic retroactive enrollment rule. You create a massive 6-month dead zone where no money enters the account. Now let's talk about step 2. What if you already made the deadly excess contribution? Listen carefully. Do not just log into your banking portal and transfer the money to your checking account like Richard did. That is a massive rookie mistake. You do a normal everyday withdrawal, the IRS will assume you blew it on a Vegas vacation. They will assume it wasn't for medical expenses, and they will blast you with a brutal 20% penalty right on top of the income tax. Instead, you must explicitly call up your HSA custodian, the bank holding your money. And you need to demand this exact thing. I need a corrective distribution of excess contributions. You have to do this before the tax filing deadline of the year you made the stupid mistake, including any extensions. The custodian will do the heavy lifting for you. They will calculate the exact excess amount plus the net income attributable, which just means the earnings. Then they will issue you a magic piece of paper called Form 1099-SA, coded perfectly. This code tells the IRS you are actively fixing a mistake. This completely shields you from that nasty 20% penalty and stops the recurring 6% tax debt. Now we move to step 3, the Form 5329 reconciliation. When you finally go to file your taxes, your CPA cannot just ignore this. They must properly and officially file IRS Form 5329. Think of this form as your ultimate get-out-of-jail-free card to hand the government. Here is your exact 4-step escape sequence. Grab a pen because you cannot afford to mess this up. Sequence is everything. Let's jump straight into step 1, what I like to call the 6-month buffer strategy. If you are planning to delay Medicare and Social Security past age 65, and you're still stuffing money into that HSA, you have to hit the brakes hard. You must forcefully stop all contributions, including your employer's matching contributions, exactly 6 months before applying. Why? Because you have to build an invisible shield against that automatic retroactive enrollment rule. You create a massive 6-month dead zone where no money enters the account. Now let's talk about step 2. What if you already made the deadly excess contribution? Listen carefully. Do not just log into your banking portal and transfer the money to your checking account like Richard did. That is a massive rookie mistake. You do a normal everyday withdrawal, the IRS will assume you blew it on a Vegas vacation. They will assume it wasn't for medical expenses, and they will blast you with a brutal 20% penalty right on top of the income tax. Instead, you must explicitly call up your HSA custodian, the bank holding your money. And you need to demand this exact thing. I need a corrective distribution of excess contributions. You have to do this before the tax filing deadline of the year you made the stupid mistake, including any extensions. The custodian will do the heavy lifting for you. They will calculate the exact excess amount plus the net income attributable, which just means the earnings. Then they will issue you a magic piece of paper called Form 1099-SA, coded perfectly. This code tells the IRS you are actively fixing a mistake. This completely shields you from that nasty 20% penalty and stops the recurring 6% tax debt. Now we move to step 3, the Form 5329 reconciliation. When you finally go to file your taxes, your CPA cannot just ignore this. They must properly and officially file IRS Form 5329. Think of this form as your ultimate get-out-of-jail-free card to hand the government. This form proves to the IRS that you have permanently removed the toxic excess funds. It officially closes the loop and legally stops that vicious 6% penalty from rolling over. Now cons. But what if you are watching this way too late? Let's move to step 4. What if the mistake was made literally 2 years ago? What if you just got a terrifying letter saying your Medicare premiums are skyrocketing because of IRMAA? Do not just accept it. You do not have to just roll over, play dead, and pay the government whatever they ask. You need to immediately jump online and download Form SSA 44. This is the Medicare Income-Related Monthly Adjustment Amount Life-Changing Event Form. Yes, it's a mouthful, but this little piece of paper is basically the ultimate cheat code against the Social Security Administration. If your income spiked artificially 2 years ago because you were fixing a messy tax issue, but today you're actually retired or you reduced your work hours, you can use Form SSA 44 to formally appeal the entire surcharge and wipe it out. You're literally telling the government, look at me, my tax return from 2 years ago is completely irrelevant. It does not reflect your financial reality today because you are living on a fixed income. If they approve it, they will recalculate your premiums based on your current lower income entirely. You entirely bypass the death spiral. Listen to me and let me be completely real with you for a second. The system is not broken. I know this is the hardest truth to swallow, but the system is operating exactly as mathematically designed. It is engineered to be a chaotic labyrinth. It relies purely on the fact that you are too busy, that you are overwhelmed, and that you will simply click enroll. They are banking on you not understanding the catastrophic collateral damage it does to your private wealth. The IRS and the Social Security Administration do not talk to each other to protect you. They only communicate with each other when it's time to heavily penalize you. Your only defense in this rigged game is absolute, unyielding, ruthless financial literacy. You have to know the rules of their own game infinitely better than the people who designed it. If this video brought you value, if it saved you from making a massive financial blunder, or if you just know someone in their 60s who is still working their tail off, do not keep this a secret. Send them this video right now. You could literally be saving them tens of thousands of dollars in compounding taxes and violently slashed benefits. Hit the subscribe button, smash that like button, and turn on the notification bell right now. Because on this channel, we don't just read the boring mainstream headlines. We read the fine print, we decode the system, and we make absolutely sure you get to keep the money you spent your entire life building. I'll see you guys in the next masterclass. Stay sharp.